Welcome back to On the Money. Everyday fund managers take charge in managing portfolios, trading activities, and investment strategies for a number of investors. And while they may be in the big league, there are plenty of lessons that retail investors can learn from fund managers. Here to help us with that is Mike Oyson, CEO and Managing Director of BPI Trade. Good afternoon, Mike. Thanks for coming to the show.
Thanks for inviting me.
I understand you have a very interesting story, about a year in the Philippines already, but a very fantastic background. Can you tell me, how did you get into Wall Street?
I actually went to Wall Street from Hong Kong. I was at another bank, and there was an opening to move to New York. And they offered me the opportunity, so I went to New York and covered a number of the hedge funds, pension funds, retirement funds.
Okay, and this was circa
2007.
2007. Okay, and so you know you've had this path so far. In a nutshell, what is it exactly that you do?
What I do right now is I run a stock brokerage business. And what I do is basically advise investors in terms of where to put their money.
Since you tell these people where to put their money, what is it like? Do you also advise fund managers?
Yes, we do advise fund managers. In the Philippines, we advise some domestic institutions. In my previous role, we gave advice to the institutional investors in the United States, Hong Kong, and Singapore. Okay,
and what is that like?
Very, very challenging. Obviously, you've got the best minds in the financial industry, and each one would have their own mandates.
Opinions or mandates, okay.
So basically you had some funds that were basically value investors. So you had to look for stocks that were very cheap. Basically stocks trading at below 10 times PE. And you had some fund managers who were growth investors. So you had to look for stocks that were, offered growth opportunities, and these people didn't care about PEs.
What would you say is the common theme, therefore, across these people you've given advice to?
They look at fundamentals.
Okay.
They look at the growth outlook of the companies. Very few of them actually look at charts. They only look at charts when it comes to the entry point and the exit point.
Okay.
Because people are trained or were trained or had been educated and influenced by the legendary investors such as Warren Buffett, Ben Graham, Peter Lynch, Philip Fisher.
And that still holds true. I guess that's why they're legends, right? It still makes sense up to today. So given that fundamentals is the common theme, what would you say are some of the learnings that you've gotten from these guys, different personalities?
There are different schools of thought when it comes to investing. You've got the value investor, that's Ben Graham, and you've got the growth investor, who is Philip Fisher.
Okay.
So I think what one wants to have is to be able to adopt different influences from these people.
Okay.
So Warren Buffett, for example, is a combination of Ben Graham and Philip Fisher.
Okay.
Is both a value investor and a growth investor.
Okay. For 101 purposes.
Yes.
Can you help differentiate the two? What is value investing versus growth investing?
In general.
In general.
In general.
Of course, in generalities.
A value investor would normally look at companies trading at below 15 times price to earnings ratio. Or when they look at price to book, they look at companies trading below book. While a growth investor is an investor who looks at EPS growth. How quickly are these earnings growing over time? And many times they buy companies that are trading at very high multiples, high PE ratios. So that's sort of the key differentiation between these two types of investors.
Okay. Now, if let's say there's a viewer watching and you're saying, I want to start investing, I want to get into this. From what you've gleaned from some of the best fund managers in the world, what advice could you give to them?
When they're starting, and this is very important, you start investing what we call the excess cash.
Okay.
In other words, this is cash that you're willing to lose.
Okay. Willing to lose.
Willing to lose, because if you invest something and share prices drop tomorrow, you might be forced to sell out. And if you're not able to sell out, it could force you to change your lifestyle. We don't want to see that.
Okay.
So I think you've got to think about how much excess cash do you have, so you won't be forced to sell at the wrong time.
Right. And excess cash, just to make it even clearer, would be amounts that are over and above savings that you would put?
Yes, yes.
Okay.
Basically, there are two types of investors. There are the passive investors, the more conservative ones, or they're the enterprising investors.
Enterprising.
Yes. And this is a word from Ben Graham, basically. So the passive investors generally, you would put your money in a fund. You'd let somebody manage your own money, or you'd resort to what you call the dollar cost averaging.
Or peso cost averaging.
Or peso cost averaging in the Philippine context, that's right. You set aside a certain amount of money every month and buy stocks. If you're an enterprising investor, what you normally do is you look for good companies. You do research. You're more active. You're more involved.
Okay. And would you advise, I guess, as a person progresses, you'd really want them to become more enterprising?
And that's basically why we have the self-directed investors.
Wonderful.
The new generation, they want to be in control of their finances, of their future, so they want to do their own research. In the same way as people spend time to look for the best coffee in town.
For you, are there fund managers that you have looked up to all these years?
Yes.
Or even as you started?
There's an emerging market fund, and it's been the best performing emerging market fund for years. And what I consistently see in his methodology is that he really looks for quality companies. He doesn't even look at forecasts over the next 12 months because he says he's got to look at a 5-year view. And these fund managers are very methodical. They're very clear on their investment process. And that's what you want to see.
Okay. What does that look like? I like that. You said very clear in their method. What does that look like?
So basically, they have a sort of checklist. They ask questions. Do I trust management? Do I trust the numbers that they're reporting to the stock exchange?
Good questions.
Do they take care of the minority shareholders? Do they have good balance sheet? Do they have good income statements? They have a checklist.
Okay. When you say good balance sheet and good income statements, can you help define that further?
When you talk about balance sheet, you normally look at a basic number, which is cash. Or if on the flip side, you ask, does this company owe a lot of debt?
Debt.
You don't want to own companies that owe a lot of money to the banks. And that's why they always say there's a thin line between debt and death. Because if a company is over leveraged, there is a risk of bankruptcy. So you want to stick to companies that huge cash.
Okay. And can you just help as a one-on-one guide again? How would you say if a company has too much debt? What guide can you give?
There is a number which investors use, which is called the net debt to equity ratio.
Wonderful.
So basically, without going to the mathematical
technical
details,
aspects.
So basically, it's your cash less the total debt. Very, very basic definition. Different people, different ways of defining it. You want to see a good number. You want to see net cash. Or if it's net debt, it's 1-to-1 ratio.
Okay. Very clear. All right. How about amongst your clients? Are there any clients of yours that you actually look up to?
Yes.
Even without naming names,
yes,
that's fine, right?
There were a few of my clients I looked up to in the United States. Some were actually hedge funds.
Okay.
The hedge funds were quite different from the sort of retirement funds. They looked at momentum investing. They look at earnings per share, the growth, what the market is missing. They look at things like reverse engineering the share price. And I like the way they look at things because they're trying to be contrarian, visionary in terms of how they look at companies.
Okay. You use the term momentum investing. Can you expound on that a little bit more?
Yeah. This sort of I'm trying to rephrase what George Soros was saying. That basically he tries to look at market psychology. He tries to look at trends and takes advantage of the trends. Because at the end of the day, there comes a point during a cycle when the emotions get in the way, when people become too excited, too optimistic.
That's very true, right.
And what he was telling investors is that you can take advantage of this. Just ride it out and don't be caught flat-footed when the cycles turn.
Okay. Last question, then we'll go to questions from our viewers.
Sure.
Can you give advice in general, again, on how people, very busy people especially, can make sound investment decisions?
First of all, going back to what I mentioned earlier, if you're very busy, only invest cash that you don't need.
Okay.
Excess cash.
That's good.
So you won't be forced to sell at the wrong time. Secondly, be very clear on your objective. Are you looking for dividends? Are you looking for growth? Thirdly, invest like a partner.
Invest like a partner. Expand.
Think of a stock as a business. Don't think of it as a ticker symbol.
Okay.
There are people behind the tickers. There is a management behind the ticker. And the question you have to ask yourself, would you entrust your money with these people? It's basically a basic question. Would you entrust your money with Henry C. or Jaime Augusto Zubel de Ayala?
Very good. And you have to understand why.
And you
right? Again, because if you're going to be a partner, you need to know what they're doing, how they do things. Fantastic. I love that. That's actually a philosophy I follow as well. This is a question now from Leticia Castro. What are the factors that would make for a good and effective fund manager?
Interesting.
You should know the answer to this.
Yes, I think one is diligence. They have to be diligent. They have to get to know the companies. They have to speak to management, speak to suppliers. Secondly, they have to be very clear what their mandate is.
Okay.
Some funds have a mandate of looking for growth companies.
Okay.
So basically, the way I look at it is, if I was going to look at the portfolio that these fund managers have, I should be able to get a certain commonality among the stocks. If they're value investors, they should be value stocks in the portfolio. If they're
Makes
growth
sense.
investors, they should be growth stocks in the portfolio. And many times you see a hodgepodge of all these stocks, and you ask yourself, do these fund managers actually know what their mandate is?
Well, that's good. It's good to now see that if it's a hodgepodge, then you know that they're a little bit confused.
Yes, that's right.
Okay. Know their mandate, diligent. Any other tips?
Again, know the math.
Okay.
They have to be able to calculate ratios and basic discounted cash flow. Take from the learnings from Benjamin Graham, basically, on security analysis, how to value companies and paying the companies at the right price.
Okay. Yeah. This is from Ben Selina. If you can only give 3 secrets, secrets from the world's top fund managers, what would that be?
One probably would be clear in terms of why you are buying a certain company. Peter Lynch said you have to be able to give a 2-minute drill on why you own a stock.
All right.
And there was an advice given to me by a client of mine in New York who basically said, when you buy a stock, write the reason why you bought the stock on a piece of paper. So when moments of panic come, you open the piece of paper and remind yourself why you bought that stock.
That's good.
So you don't panic.
Right, and you're obviously assuming that it was a good reason
there was
to
a good
begin
reason.
with, right?
And you sell only if the situation has changed.
Right. Okay.
So be very clear.
So know your goals so your emotions don't take you in different directions.
That's right.
That's what you're saying.
Secondly, you also have to invest on companies in what you consider to be a circle of competence. And this is a word I borrow from Philip Fisher. Basically, go with the familiar. Go with businesses that you understand. Go with simple companies. Like if you don't understand mining, then why invest in mining? If you're into consumer, the consumer sector, if you work in the consumer sector, buy companies in the consumer space. You know them, you know the suppliers, you know the clients, you know the customers.
Again, like what you said earlier, would you want to partner with these companies, right? You need to understand that too. Those are 2 great pieces of advice. Anything more?
The other thing is contrarian.
Contrarian.
Contrarian. Don't go with a groupthink. Don't go with the hottest stock tip. And many times, if you look at the top investors, they are very unpopular in many situations, right? Because they buy stocks that people don't want to touch. And that's why these companies are trading at very cheap valuations, because they're unloved, underappreciated, and people are not taking a closer look at the stocks at one point in time. Okay,
great. Closing question. Wolf on Wall Street.
Interesting.
Your thoughts, Mike? You've been there.
It's a very exciting movie, but you know, when I was looking at it, I said probably I was on the wrong street.
Why?
I missed a lot of the action.
The craziness.
The craziness. Probably when I went to Wall Street, there were so many regulations that were put in place on Wall Street.
At that time already. But can you imagine that it could have been like that
It's possible. Nothing is impossible.
Nothing is impossible in Wall Street.
Until you have all the successes in Wall Street.
Wonderful. Thanks again for your time, Mike. And that's our show today. I'm Edric Mendoza. Send us your money questions via email, Facebook, or Twitter. And view this episode again at anc.yahoo.com or at iwanttv.com.ph. Join us again tomorrow as we bring you more tips on how to save, invest, and manage your money. Thanks for watching.